Hello, everyone, and welcome to this week's podcast. Today, we're actually recording this as of June the 9th in the afternoon here, but you'll probably be hearing this on the 10th. But still prevalent action happening within the market, although been somewhat muted this week as far as returns go. We've seen equities pretty much flat. A few of the indices are in positive territory, a few are in negative territory. And taking a look at that chart of the S&P 500 right now, we've pretty much since the beginning of June seen it move sideways on the chart, really trading within that range between 4160 as well as that 4100. Actually, with today's action, we saw it reverse down to 4100, setting up what might be a potential quintuple top if it's able to rally above 4180. So seeing some sideways action, but that doesn't mean we have been without a lack of things to occur within the market. And two things that we'll look to talk about today, first going to be sort of what rallies we've been seeing, what indicators we've seen pop up, but also we're going to focus on one sector in particular, and that's where I'll invite Mr. Tozzolo in here to talk about that particular sector, and it's being energy.
Yeah, and we ran a piece in a report on Tuesday, so if you want to go read that, you definitely can. We'll cite that a bit today. But when we look at the bullish percent for energy for the economic sector, so all energy stocks there, that bullish percent crossed above 70% at the end of May 31st to be exact. That's the fourth time it's happened since 2021, but before 2021, it actually hadn't happened since 2011. So we went almost a decade without this indicator reaching above 70% or seeing this kind of breadth and participation from the energy sector. So we wanted to look at returns following that for both energy as well as just the broad market, the S&P 500. And what we found was the typical adage with bullish percents is once you get above 70%, you may see some frothiness in the market. And that happened to be pretty true when it comes to the energy sector. We used RYE, which is the Invesco Equal Weight S&P Energy Fund. So you can check that fund out. But felt like using an equal weight was preferable to using a cap weight just to get a better representation for the whole sector. Now, the returns, when averaged out over the occurrences going back to 1995, they were pretty muted in the short term. So 1 week, 1 month, pretty much flat to slightly negative returns for that energy ETF. And we saw a similar thing for the S&P 500 as well, where the short term, you don't really see any robust returns whatsoever. Now, when you start to go further out on the curve, because, most of our users are going to be more focused on, quarters, maybe a year out or so like that when they're looking at their investments. And, we saw that the energy fund typically does well on average 1 year out. RYE actually had an average return of 13.46% with a median of 13.72. And then when you compare that to the S&P 500, you actually had an average return of 0.24%, but a median of 5.23%. So, averages can be a bit deceiving, especially when you have a lot of outlier cases. And that's something that we saw when looking through the data here. We'll probably include an image of the scatter plot here in the podcast. But looking at that, you can see that quite a few of the energy, there's some really high returns on the 1 year out. So you see a couple that actually see three occurrences where the 1 year return was north of 60%. You actually have one occurrence where you had a return of negative 45%. So you can get some pretty extreme readings, while on average you typically do see positive returns in the long run. Though that positive rate of return for 1 year was roughly a little over 60% for that energy fund, a little bit lower for the S&P 500. And with the S&P 500, you do see some strange trends here. So even though the average return was only 0.24%, which does, may at first glance may say, oh, well, the S&P 500 really doesn't do much during those time frames. It's actually really not the case. When we look through that data set, we actually had 10 occurrences where the S&P 500 had 1 year returns north of 10%. And we also had 10 occurrences where the S&P 500 had a 1 year return of less than -% or worse than negative 10%. So you do see some pretty extreme returns for the S&P 500. Now, what you can really gather from this is it's not necessarily an ideal environment for the S&P 500, even though you do have periods where you can have nice returns. It does seem like those drawdowns are much more prevalent during periods where you have a really strong energy market. And, a couple of things we've talked about with clients over the past couple of weeks is, a lot of them have picked up energy exposure, which they, probably should have done given the strong momentum and relative strength that we've seen in the sector. But recently, you have crude at 120, which is, you look historically speaking, is very high. You can definitely get shorter term dislocations higher than that, but it's extremely difficult unless, something really bad's going on. So you are seeing the raw crude prices nearing the top of their near the top of their historic price range, although they can definitely go much higher. But you are getting some of that resistance there from a long-term standpoint. And then you also see, the bullish percent for energy at north of 70%, which is usually where we see some frothiness, as we touched on a little bit earlier. The short-term returns usually aren't great following those types of periods. And you do see a lot of those stocks individually have overbought or sold readings of 60, 70+%. So they are getting a bit extended on the short term, as well as when you look at crude oil prices are pretty extended as well.
They are. And I mean, it is one of those things that, folks, especially in recent calls, I don't know about you, it feels like folks are going, well, energy is getting to this certain price level, or my energy stocks are getting up here. I'm going to look to move elsewhere. And truthfully, the unfortunate question or the unfortunate thing has been you haven't had many other options to go to. Because, I mean, even looking at a lot of the indicator action recently, it's been sort of a mixed bag. One of the things that we'll take a couple of steps back to sort of come back to my original point here that I wanted to look at. We saw on the indicator front, we saw the positive trend for the NYSE move back into a column of X's there at 40% earlier this week. But we also saw that multiple buy for the NYSE move back into a column of X's. And for those that aren't familiar with that multiple buy signal bullish percent, it's measuring the percentage of stocks that have given two consecutive point and figure buy signals. So you've not only seen one buy signal, but you've also seen another showing a little bit of follow through. And what's interesting is earlier this week, when I was taking a look at a lot of these stocks that you've seen in this space that have given multiple buy signals, it's come from really three primary sectors. And that's going to be first, not all that surprising, energy, as we see, we've talked a lot about energy. The other two have been our beaten down sectors, technology and consumer cyclical. I mean, two prime examples of looking within, especially that tech space. Well, the best example I could think of is looking at like Adobe Systems, ADBE. It's given two consecutive buy signals off of a recent bounce here, is looking to test that trend line as well. So when you're looking at some of these charts, especially when we've seen these bounces out of a lot of these stocks that are giving consecutive buy signals, obviously it's nice to see some initial follow through. But with some of these positions, and that's sort of one thing that we're trying to get at here, especially with these tech and cyclical positions, we're going to need to see some additional follow through. Now, as we've talked about, the energy space at the moment is sort of the best in class. We have seen that, as Joe mentioned, seen that bullish percent get fairly high. So is a bit of a level where, one might begin to start lightening up. But in many ways, as we touched on, there's not a whole lot out there that's more options that you can look to. So energy is at the moment our strongest that we can go to. And that's where we're seeing the participation. That's also where we're seeing a lot of the indicators sitting at high levels is within that energy space. So, at least it's one of those things in the back of my head. I remember, TD talking in the back of my head saying, the market's going to do what it wants to do, and it's going to be until it isn't. They seem like cliche adages in many ways, but even when we're talking about that type of energy exposure, or even when we're looking and talking to folks about possibly dipping their toes back into tech, because tech was such a leader for such a long time. This is what it is until we're told it isn't. So it's one of those things that we will leave you with this week, as hopefully we might see some additional changes, additional improvement within the indicators, within the indices as well. That's something we continue to monitor each and every day. So as always, we appreciate you tuning in, reading our research and the like, and feel free to stop back by next week. And thanks again for stopping by on the podcast this week. Hope everyone has a nice week.